Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the US, but it's going to be a slow growth environment, below trend. The Fed wants below trend.
With inflation this high, I'm in the mode of we need to err on making sure we're getting inflation down.
Like in a Greek tragedy, there's just not that much that they can do. There's destiny that's approaching. The economy is weak. When we talk about supply chain disruptions, we're not getting our exercise bikes. When they talk about it, they're not able to heat their homes. That's really weighing on sentiment in the euro, and the ECB doesn't have a tool to address it.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Taking back control, Neel Kashkari says the Fed needs tighter monetary policy to keep inflation in check. Cautious mood, stocks fluctuate as investors look ahead to Jackson Hole, and 6 months on, Ukraine marks a tense Independence Day as it hits the half-year milestone since Russia's invasion. Now, this is what the markets are telling us. Of course, to focus firmly on Jackson Hole and that Jay Powell speech on Friday. European stocks down 0.5%. If you look at S&P futures, also down 0.2%. Euro dollar 1.9954. We have some great feature pieces on the Bloomberg terminal and on the website looking at what this means for some of the import-export companies, and then that U.S. 10-year yield above 3%. I would suggest a lot of the volatility, of course, will continue to play out in currencies. Talking about currencies, it's different if you're a German exporter or if you're a French exporter. So let's get straight to the European picture and the European map to see exactly the difference. You can see the FTSE down 0.9%. I was looking at the industry groups actually earlier on, a little bit of upside, but really a tiny bit, I think 0.5% higher for some of the consumer stocks. Everything else feeling pressure, the CAC down 0.4%. Now, the Minneapolis Fed President Neel Kashkari says action from the central bank is still very much needed in the fight against inflation. Well, he spoke at a gathering at the Wharton Club of Minnesota.
When inflation is 8% or 9%, we run the risk of unanchoring inflation expectations and leading to very bad outcomes that would cause us to have to be very aggressive, Volcker-esque, to then re-anchor them. We definitely want to avoid allowing that situation to develop. So with inflation this high, I'm in the mode of we need to err on making sure we're getting inflation down.
Now we're joined by Vivek Paul, Senior Portfolio Strategist at BlackRock Investment Institute, and Christina Aquino. She's back from New York from our markets team. Welcome back, Christine. So good to have you on TV. Vivek, let's start with you. When you look at some of the market falls or certainly the little market correction, how much more do we need to correct to be at a comfortable place to deal with energy prices?
Well, I think, if you look at the events over this summer where we've seen what we think is ultimately a bear market rally, our view has been that some of the market reaction has been effectively a little bit more on the hope of some sort of Goldilocks scenario out, playing out. That's not our base case, and we think that we're still in an environment where we'd be cautious for the next 6 to 12 months on a tactical horizon basis across a swathe of DM equity.
Okay, this is a concern, right, that we haven't really seen the worst for equities. Jackson Hole, I know, is the big focus this week. What's the next catalyst?
Well, Francine, I think it really is going to be what Jay Powell says at that speech. And I think, if we're to believe Neel Kashkari in saying that the Fed is going to have to do more, then I think that's what people are going to be expecting, that other shoe to drop. And as Vivek mentioned, this is still a bear market rally. That's very much the consensus that's out there. And it really just seems like there's this feeling of biding a little bit of time, maybe taking some profit before that next leg lower in equities.
Vivek, is there anything you want to be invested in with conviction? The key word being conviction, not just invest.
Look, honestly, it's tough in the near term, but I think it is important to have a differentiated view between the very near term, sort of the next few months, and the slightly longer term picture. By no means am I saying that, you get past the next few months and then it's all rosy again, but I think it's worth saying that when you have a sort of strategic horizon type sort of tilt to your portfolio, we would still be long equity. I think the point being that the next 6 to 12 months is tough to make a strong case.
With quite a lot of volatility in currencies, or in equities too?
And I think quite a lot of volatility more generally, because in the environment that we think we're in, we think we've entered a new regime here. This is an environment of higher macro market vol for the foreseeable.
What's your take on what we're seeing in currencies? I mean, we saw parity, and it's amazing to me that actually we saw parity euro-dollar, but the market didn't freak out as much as we thought they would.
Yeah, well, this is the second go at it now, Francine, right? But it's really, really interesting because, you know, the dollar has really had such an incredible run in the first half of this year. And, you know, there's this feeling that, oh, perhaps the Fed has started to do enough to start seeing that inflation finally come down. And perhaps this is the opening for other currencies to kind of regain some of that lost ground. But I think, you know, investors are taking a look at the comparison between the Fed, for instance, versus the BOE and the ECB. Yeah. The Fed is still very much ahead of these two central banks, and therefore the dollar really still powering higher against both the euro and the pound. So it really does depend now, I think, on that comparative action and whether the BOE and ECB can gain ground in the Fed here.
Yeah, Vivek, and we have this great dollar chart looking at the dollar rally actually pausing somewhat. I mean, this kind of changes everything, but I wonder how long it will take for us to work out through the second round effects of what we're seeing in energy prices. Already we're seeing in the US, 1 in 6 households struggling to repay those bills.
Yeah, and I think the trouble is, again, to my point earlier, I think we've yet to see the worst. And right. I think for our view here, I think the point would be that the markets have been reacting as if the Fed is on the verge of pivoting. We think ultimately they will pivot, but we don't think we've seen the signs yet to suggest that's coming right now.
You know, my concern, I understand that the central bank, in general, actually, central banks are in a really tough place, but it does seem like, you know, they're reacting to data point, which means that they don't really have control of the narrative. Is this us really coming to the limit of what central banks can do when it's a supply shock inflation? Well,
completely. And Ian, to the point I made earlier, this is exactly the reason why we believe we're in this slightly different market regime. You know, we've been calling for this higher era of macro market volatility. It's because, to your point, supply is dominating and leading the fact that inflation is being created. We're in a situation where, of course, inflation is always about demand and excess of supply, but it's supply, it's the production capacity that's unusually low at the moment. Central banks only have a blunt tool to deal with that.
Did you miss us when you were in New York? Because the European markets are that much more exciting. Because for 10 years, they've underperformed. When are we ever going to overperform, or, you know, here in Europe?
Oh, Francine,
not now.
Yeah, not right now. Definitely not right now. I mean, this is the age-old question, isn't it? Yeah, it's really, really interesting. I mean, Europe, this was meant to be the year for Europe, wasn't it, right? This is the year of value, a little bit of a backup from that growth play that we've seen, which, of course, the U.S. is very heavy on. But, yeah, it just really feels like, just from the perspective being on the other side of the pond, that Europe was really in a tough place, is still really in a tough place on several fronts, you know, not to mention what we're seeing in the markets. We also have this energy crisis that we're all seemingly bracing for this coming winter. And then, of course, you're hearing really just kind of negative headlines regarding economic data, both out of Europe and, again, the UK. So it really seemed like, you know, while I was over there, it's kind of like, man, Europe is having such a tough time right now.
I mean, I'm getting popcorn for that Jay Powell speech on Friday because it kind of all rides on him. So we'll see how he puts the nuances. Thank you so much, as always, for some great analysis. Vivek Paul there, Senior Portfolio Strategist at BlackRock Investment Institute, stays with us, as well as Christine Aquino. Now, coming up, Musk gets a potential boost in his paddle with Twitter as a whistleblower comes forward. So we have more on that ahead. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Canada is planning to start shipping green hydrogen to Germany. The Prime Minister Justin Trudeau and the Chancellor Olaf Scholz signed a 5-year agreement for the fuel to be produced by wind power in Canada's eastern provinces. Now, the aim is to create a transatlantic supply chain for hydrogen with the first deliveries by 2025. Now, of course, this all comes as Europe deals with an energy crunch. We're back with Vivek Paul, Senior Portfolio Strategist at BlackRock Investment Institute, and still with us, Christine Aquino as well. So, Vivek, we were talking a little bit before, of course, about the fact that the market hasn't really priced in the worst-case scenario when it comes to energy prices. Do you worry about zombie companies or small businesses going under, or do you worry about consumer spending and households more?
I think we've got to worry a little bit about both. And I think, picking up on that second point, while, you take the case of the UK, we have seen some material kind of write-downs in terms of earnings expectations, particularly for those kind of consumer-facing sectors. But arguably, the worry is that that has not gone far enough. And you look more broadly, not just across the UK, you're looking at earnings projections across the board. In general, it's not obvious that they're really placed for the downside that could indeed occur. And maybe that's part of the reason why we need to be a bit cautious at this moment in time.
Yeah, so what does this caution look like, actually, as we get into the winter months? Again, there's a bit of holiday mood, I guess, overhang. Do we worry about credit card bills?
Absolutely, Francine. I mean, really anything that kind of indicates more weakness in the consumer. Again, I think we're already starting to hear, for instance, of households kind of starting to default on some of their energy bills or thinking about, the tough choices that they're going to have to make. And I think this is very much what central bankers are trying to keep an eye on, especially as we head into the winter months. This is probably the reason, for instance, that we got that massive pivot from the Bank of England a couple of weeks ago and indicating that they're going to be doing a lot more. But the question is it going to be too little too late? Right. Markets are certainly expecting them to deliver and over-deliver in that promise, but the question is, will they?
Right, and I guess it all falls on fiscal policy, right? Can Vivek, the EU, or I would say in the UK, avoid recession or go through a shallow recession if we have enough support from the government?
I think recession, this isn't going to be like headline news here, right? I think recession is pretty likely. I think in both in Europe and the UK, we're probably already there when we look back on retrospective data and some aspects. But I think the question as to how bad it gets, I think that will be really important in terms of thinking about how the energy sort of shock plays out in different ways in different of those markets. I think you're looking at the UK, you're seeing not just, I guess, the impacts of the energy shock, but also you look more broadly. We've been in a situation where there are just fewer people effectively in that labour market, that the supply has been challenged, and that is, I think, contributing to the UK weakness in this moment.
And there's not, and I keep on asking this, I know this is a supply shock coming from energy, which really permeates to everything, but this is not also an overhang of COVID, or is it?
Well, no, I was going to say that. So, I wouldn't put this all down to energy. Obviously.
What percent is energy?
I think it's very hard to kind of disaggregate. But the thing I would say, that obviously it's 6 months to the day of the invasion of the Ukraine, and I think the point would be that it's tempting to just look at that and say that was the starting point of all what we're seeing now. I think it's bigger than that, and I think the point I was making before about this new regime where we're kind of in this environment where supply shock's dominating, that was already the case. So what you had then, I think, was the energy stuff kind of layering on top of an existing environment where supply shock's dominating. So I think both are at play, and I think it's tempting to see that it all started with Russia's invasion of Ukraine. I don't think it did. I think it goes back beyond that.
Okay, so years of what, underinvestment?
No, I think it's more this idea that, we're now in an environment where you talked about the overhang of COVID. I don't know if it's just about COVID, but COVID was an example of this, where effectively supply is a thing that's dominating, right? Yeah. So I think at that point, we're in that regime now.
I have a million questions on China. Actually, I have a million questions in general, but how do we read China right now?
I think the news that has been coming through is still very much being interpreted negatively by markets, Francine. But I do think I was a little surprised, for instance, when we got the news of that surprise rate cut from the People's Bank of China a week ago, that it wasn't taken as negatively as I would have expected. But I think, we knew this story of the bifurcation between Chinese economy and the U.S. economy in particular, even at the start of this year. And that really is just more evidence to that. And, it's going to be very interesting. Again, these are the world's biggest economies going very much the opposite way in terms of monetary policy and arguably in terms of the growth story as well. And so, that will have some very big repercussions towards the end of the year. It's just unclear to me at the moment what those repercussions are going to be.
Vivek, at some point, do you assume, and maybe I assume wrongly, that actually PBOC, but China policymakers will just have to do more to support the economy?
Well, I think that's what we're all watching for, right? And I guess the word you mentioned earlier, surprise, I think it did take people by surprise. So clearly, we're seeing that there is a level of activity which will cause the policymakers to step in. But I think, for a long period of time, we're probably expecting a little bit more in terms of the policy than we've seen. So I think second-guessing it is difficult. I think, as we're looking forward to next year, the environment that we saw at the start of last year in the West, of the idea of the restart, that's something that ultimately will play out at some point in China as well. So I think there will come a point where growth will naturally be strong from restart dynamics. It's in the interim, in the bridging period, how much policy support do we need? And I think that's a hard question to answer.
But does China have the capacity of taking the world down with it?
I mean, that is very much the fear, Francine, definitely, because, again, I think the initial economies that will get sideswiped, of course, are the beneficiaries of that Chinese demand, right? We're talking about your iron ore producers in Australia. We're talking about some of the economies within the Asian region that very much depend on that China supply chain type story. And so that is very much the fear, I think. But then I guess it's kind of also in danger of creating this bifurcated world where economies that are less exposed to China, particularly in emerging markets, will start doing better than those who are very much exposed to China. We could well see this kind of divide that goes beyond just the US and China, but also the economies that are exposed to these respective countries.
And I wanted to ask you also, Vivek, about currency dynamics and what this means. I mean, the dollar's strength we've seen so far, what this means for emerging markets.
Yeah, it's tough. I mean, so we're not making a sort of big sort of positive story on the emerging markets at this moment in time because of the uncertainty that we're seeing, particularly in the near term around that dollar strength. And in particular, if you believe that, as I was saying earlier, that some of the markets kind of hoping that the Fed is about to pivot rather than actually seeing it in terms of what they're saying, there could still be more strength yet to come, I think. And therefore, this isn't an environment in which we're kind of particularly leaning into emerging markets. You know, I've already mentioned the point that on a tactical horizon basis, it's DM that we're actually underweight. But longer term, actually, we think DM actually probably offers a little bit of a better bet in terms of the equity space, on a beta level at least.
I'm going to put you both on the spot. Is there a favorite indicator or a favorite chart that you look at that not many other people look at to give us an indication of where the economy is headed? Vivek.
Favorite one. So I think
least favorite one.
I mean, I think, to be honest, I think it's probably something everyone else looks at. I think it's the key to the story at this moment in time is what the markets are expecting that central banks will do relative to what they will actually do. And I think, therefore, looking at how market expectations change on sometimes not much news, I think that's the key thing to watch.
Well, for me, it's the lipstick index, Francine.
Of course.
what else better indicator there is? Exactly, yeah. No, I think really it's going to be very much the focus is on the consumer, how they react to how policy is playing out in the real economy. We know, of course, that there is a bit of a lag there. And so it might be some time before we start seeing the effect of that on inflation. And again, whether that starts to kind of like be reflected in consumers' wallets. But it is very much the focus, I think, for central banks and markets. Both.
We also have a new full English breakfast index and a mayonnaise index, but we'll get onto it a little bit later. Christina Guino and Vivek Paul, a senior portfolio strategist at BlackRock Investment Institute. Thank you both for joining us. Coming up, we're looking ahead to the Federal Reserve Chair Jay Powell's speech at the Jackson Hole Symposium. Don't miss our coverage of that. That starts on Friday. This is Bloomberg. French President Emmanuel Macron there. Live pictures we understand from the Élysée Palace, his first cabinet meeting since the summer recess. I was looking at approval ratings for President of France. They were actually dropping by 1 point in the past month as he was overtaken by his Prime Minister, Elisabeth Borne. This is according to the Journal du Dimanche. Now, the monthly poll actually showed that about 37% of those surveyed were satisfied with Macron's performance, down from 38% in July. It'll be interesting to have a listen at what Macron, I don't know if it's a pep talk. I mean, what do? Do you come after some recess and do you set out the agenda, or is he saying like, guys, we've got to rally the troops, we've got to pass reforms and onwards? I wonder whether it's a pep talk. I'd quite like to get a pep talk from Emmanuel Macron, or from anyone for that matter. No matter, let's get straight to the Bloomberg. First Word News, here's Leanne Gerrits. Hi, Leanne.
I'll give you a pep talk later, Francine. Canada is planning to start shipping green hydrogen to Germany. Prime Minister Justin Trudeau and Chancellor Olaf Scholz signed a 5-year agreement for the fuel to be produced by wind power in Canada's eastern provinces. The aim is to create a transatlantic supply chain for hydrogen, with the first deliveries by 2025. Now, it is reported that almost half of the European Union is under drought conditions, with the weather set to remain warmer and drier until November, as well as affecting vegetation and crops. The report notes severe impacts on the energy sector, particular hydropower and the cooling systems of other power plants. Here in the UK, Liz Truss is the favourite to be the next Prime Minister, and she's confirmed she would hold a fiscal event in the first weeks in office. Speaking at a Conservative Party meeting, Truss hinted at targeted cost of living support for pensioners. Her campaign has signalled she would not wait for the usual budget estimates before delivering action on those soaring energy bills. The result of the leadership contest will be announced on the 5th of September. And tributes are being paid to Julian Robertson, the billionaire founder of Tiger Management, who has died at the age of 90. Robertson became one of his generation's most successful hedge fund managers, but by the late 90s, his funds had $22 billion in assets and annual returns averaging 32%. But a wrong-way bet on the yen led to losses as he closed the funds in 2000. In later years, he was celebrated as a mentor to a wave of investors, and they were known as the Tiger Cubs. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Liam Gerrans. This is Bloomberg. Francine.
One of the brilliant minds, of course, when it comes to investing. Coming up, 6 months since Russia's invasion of Ukraine, and the global economy will never be the same. We'll get the latest on the state and the conflict. This is Bloomberg. Taking back control, Neel Kashkari says the Fed needs tighter monetary policy to keep inflation in check. Cautious mood, stocks fluctuate as investors look ahead to Jackson Hole. And 6 months on, Ukraine marks a tense Independence Day as it hits the half-year milestone since Russia's invasion. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus in on Ukraine, and the U.S. will announce another $3 billion in arms later today. Now, this as American officials have warned Russia may step up in strikes in the coming days. Today, Ukraine celebrates its Independence Day, which also marks 6 months since Russia's invasion. Now, we heard from a number of world leaders today and yesterday, and they're pledging continued support.
We are united in supporting Ukraine, also because defending Ukraine means defending the rules-based international order that our two countries rely on.
I would like to call upon Russia to cease the military actions and to withdraw its forces from the territory of Ukraine.
Let's get the latest now from Mark Champion, our senior reporter for international affairs. So, Mark, we're 6 months in. We've had warnings that actually Russia strikes may intensify. What does that mean in terms of state of play?
Well, you know, this has been an intense war for quite some time, you know, these will be really punitive strikes, demonstrative. There's really very little movement on the ground. And the Russians, in fact, are digging in the south so that they can sort of ward off any attempted counteroffensive by the Ukrainians. In the east, the other main front, the Russians are making extremely slow progress, if any, at this point.
I mean, there's been some horrific reporting, of course, about cages, you know, in certain parts of Ukraine to put the prisoners of war, the Ukrainian prisoners of war, on trial, about also children being misplaced or sent to Russia to be adopted. Are there any signs of this coming to an end, of, you know, the end being close?
Unfortunately not. I mean, the Indonesians have been trying to broker some kind of talks, but very quickly said there's no interest, not from Zelensky, who today, to mark Independence Day, said, look, we're not interested. We were interested in peace at the beginning, peace talks. Now we're just interested in victory. And from the Russians, they also haven't reached even their minimal goals, so there's no interest there. The Russians have stated that.
You have a great piece today. Congratulations. We'll also push out on social media, looking at, you know, the perceptions and how that's changed of the military might of Russia because of the war in Ukraine. Is this perception also within Russia?
You know, that's difficult to say. There's still strong support for the war. There's stronger support now than there was at the beginning of the war. So it's difficult to say. We really don't have a good handle because there's so little free speech, free media now in Russia. it's difficult to really gauge how people feel. The one thing, you know, kind of good guide that we have is, are people signing up to mobilize? Are they signing up to join and go fight the Ukrainians in the way that the Ukrainians are signing up to go fight the Russians? And the answer is largely no. And the Russians are really having to scramble to get mercenaries, etc. They also dug into their allies among Syrian militias, and they're going to Chechnya. They're going to a lot of different places to try and get them. They are trying to mobilize different forces in different places, but the best information that we have is that it's not a tremendous success.
Mark, thank you so much. Our senior reporter there, Mark Champion. Now, let's dig into the economic fallout that we've seen over the course of the past 6 months. Joining us is our Lizzie Birding, looking at the economic impact. Lizzie, I mean, just to put it simply, if you look at the sanctions, they haven't really worked, in the way that we thought they would cripple the Russian economy.
And that is what we thought at the start, but no, it doesn't seem to be that way. Though it is true to say that the data are very unreliable out of Russia, more so even than before the war. You're seeing Chinese exports to Russia up, and even you've got oil and gas prices up, but volumes down. But because of the higher prices, it means that in sales terms, value terms, the exports are up. So that's lining Putin's coffers. Actually, it's a difficult picture, even if the economy isn't crippled. But the comfort, if you can put it that way, is that sanctions are a slow poison. Russia's suffering from brain drain. You've had an estimated 300,000 people leave already. They tend to be the young, entrepreneurial, urban people. There'll be more as the war carries on and the economy weakens. And even if the war ends, Europe's going to continue to wean itself off Russian energy as fast as it can. So the West can only hope that this pain's worth it.
So in terms of European countries, because of the energy price that's gone up, I mean, who's suffering the most? Or it's kind of like the world in reverse, I guess.
Yeah, it's Germany and its eastern neighbours who are bearing the brunt of Russia cutting off the gas supplies. But then everyone in Europe scrambling for stocking up for the winter, which means that the wholesale gas prices, as we know, have gone up to dizzying heights. Even the UK, that isn't so dependent on Russia for raw energy, because of its storage model, has double-digit inflation. And so it's a headache for central banks that are having to hike interest rates into recession, and it's a nightmare for politicians. We don't know in the UK, for example, how the next Prime Minister is going to handle it, so it's creating market jitters. But above all, let's not forget, Ukraine is suffering the most. The IMF sees its GDP shrinking 35% this year. There's already talk about reconstruction, and Ukraine's going to have to rebuild its farmers, its industries, its businesses if it wants to end the war on its own terms.
Lizzie, thank you so much. Lizzie Birding there with a look at, of course, some of the sanctions. Now we're joined by Judy Dempsey, non-resident senior fellow at Carnegie Europe. Judy, talk to us a little bit about how you see this ending.
I think what Mark Champion was saying is it's very difficult to even make any kind of predictions. The longer this war goes on and the brutality that's meted out to the Ukrainian citizens, the sense is that President Zelensky of Ukraine will not actually be ready to hold any kind of negotiations at the moment, nor indeed will President Putin, despite the fact of the extraordinary destruction taking place. And what we don't know is the number of deaths on the Russian side. So essentially, talking about an end game, it's certainly not in sight at the moment.
So, Judy, what does it tell us in terms of what the next step is? I know we were speaking also to Ukrainian MP asking for more arms, but also more tanks. Is there a point where it just becomes much more difficult for a lot of the Western countries, because of the energy crisis, to support Ukraine with arms?
Well, this is the big question that actually is not yet being asked in many European Union member states. At the moment, there is this kind of solidarity with Ukraine. There's no doubt there's a sense that, well, given the energy prices, given the drought, given the extraordinary impact of the climate over this past summer, there's a sense, well, wouldn't it be good if this war could end? The real problem, which I see sitting here in Berlin, is that where's the diplomacy? We had a little bit of diplomacy when it came to trying to get grain exports from Ukraine out to the rest of the world. But where's the diplomacy? Where's the political push to try to mediate? And at the moment, it's just not there.
So, Judy, what comes next? When you look at what we also heard from Zelensky, and I know it's very, very difficult today because of Independence Day, because of all of this talk about extra violent attacks from Russia. But how does this end? Do we need to find peace and compromise, or is it really one country over the other?
Conflicts are very difficult to end because what happens with the conflict, and you look around the world, is that they create facts on the ground. And once one side creates facts on the ground, the other side, whose land or territory has been compromised, is very unwilling to accept those facts on the ground. This is a huge problem now facing the Ukrainians. At what stage could they even be invited or encouraged to go to the table? But as Zelensky says, and he cannot say anything more to his people, we will go to the table when we get our land back. And at the moment, this is his mantra, this is his wish. This is the support from the Ukrainians. And as for the Russian side, it's actually very difficult to know for how long President Putin can sustain this kind of aggression with so few gains.
Judy, is there a mediator in this? We know that it's unclear what China and India are doing, right? Or that they haven't really condemned Russia, that they're buying some of their energy sources. Will we see a turnaround in that?
We're not going to see a turnaround with India. India is being very, very careful with its relations with Russia, with its relations with China, with its relations with the United States. We can actually rule out India playing a role, and it's not its forte. China, we've been waiting for China to play some role, but its interests are kind of bilateral with Russia, what it can extract from Russia in this conflict, which is very unsettling for China because it sees how the West, as we know it, is actually quite united. The United States is not in a position to play a role. And of course, the European Union, because of the sanctions and the suspicion and how Putin wouldn't entertain the EU playing a role, we don't see any mediators yet. We did see the mediators of the United Nations and Turkey playing a role over the grain issue, but it'd be interesting to see what kind of agenda the United Nations has on its plate at the moment. But so far, we don't see anything in sight. And the longer this goes on, the more tragedy, the more deaths. And don't forget the huge impact of migration. There's 5 million Ukrainians outside Ukraine. And let's not forget the internally displaced.
Judy, where do you see the biggest fault line? We know and understand there's like horrific stories coming out of Ukraine, and then there's really stories of hope. Like, what do you read to try and have a real understanding also of the support this war is getting inside Russia?
These are immensely complicated questions because if we knew, then we would see some kind of end in sight. There's one aspect of Russia, and Mark Champion brought this up, that for the moment, the support for the war is there. But you must remember, there are so many young Russians outside Russia who are engaged in civil society, who are trying to help the Ukrainians, who are creating a kind of new young Russia outside Russia. And it's a huge economic brain drain for Russia itself. For the moment, this doesn't affect President Putin. But in the longer term, this is extraordinarily damaging for Russia, not to speak of the huge reconstruction costs for Ukraine. This is not a win-win for Russia by any stretch of the imagination. For the long term, it's pretty miserable.
Judy, thank you so much. Judy Dempsey, their non-resident senior fellow at Carnegie Europe, joining us this morning. Coming up, the Jackson Hole drum roll. More on our conversation with the Goldman Sachs chief economist Jan Hatzius on the Jackson Hole. We'll get his views on what to expect from Jay Powell later this week. This is coming up on Bloomberg. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, traders bracing for hawkish talk from Fed officials at Jackson Hole later this week. Goldman Sachs chief economist Jan Hatzius told us he thinks Jay Powell will signal a slower pace of rate increases.
I think the U.S. doesn't have quite the same degree of headwinds as both China and Europe. In China, obviously, you have the zero COVID policy and the property market downturn, which is a multi-year development. In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the US, but it's going to be a slow growth environment, below trend. The Fed wants below trend. That's why financial conditions are where they are, because the Fed's tightening pretty aggressively. And you've got the fiscal drag. So plenty of headwinds for sure, but I don't think it's quite as bad as in China or the euro area.
How do you expect Chairman Powell to navigate that, Jan, this Friday?
I think he'll be balancing between two things. One, I think he will lay out a case, as he did at the last press conference, as they did in the minutes, for slowing the pace of increases. We had 275 basis point moves. Our expectation would be, barring significant data surprises, that the September move is 50. I think I don't think he'll be specific about the number, but I do think he'll be saying, there is a risk of over-tightening, and therefore it makes sense to go a little bit more slowly than these really outsized increases. But at the same time, he'll make clear that the job is not yet done. Inflation is way too high. They're very committed to bringing inflation back down to 2% or thereabouts. So I think it will be a balancing act.
Yeah, and there's a mix here of themes, and one of them is what we just saw from Macy's, where Bloomingdale's and the haves do well, and Macy's and the have-nots really are struggling. Or it can be John Taylor of Stanford visiting with Bloomberg in the last 24 hours, saying sustain a higher yield environment. Are we getting our x-axis wrong right now? Do we need to look out 2 years, 3 years, or 5 years of elevated inflation?
I think a year from now, or 2 years from now, inflation will be much lower because there are some drivers. I mean, commodity prices are clear. The goods sector in general, I do think that's going to come off a lot. The risk is more on the services side, where we've seen less of an indication that things are slowing, especially rents are still growing very quickly. So I think that's still going to be well above normal, into 2023 and maybe even beyond. So I do think that there are going to be improvements, but not everywhere.
Well, that was Jan Hatzius, chief economist at Goldman Sachs, speaking with Bloomberg's Tom Keene and Jonathan Farrow. Now let's get to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Nordstrom has seen its shares sink in late trading after the U.S. retail trimmed its full-year outlook. The department store operator says it will move to aggressively clear out inventory, a profit-eroding measure that has also been necessary at other retailers as the industry wobbles following the pandemic shopping binge. Investors saw Nordstrom as insulated by its affluent customer base. Now, battery-making giant CATL has reported an 82% jump in first-half profit. The Chinese company saw profit of $1.2 billion, beating estimates as it bounced back from a disastrous start to the year that saw its sharpest ever drop in quarterly earnings. CATL shares have gained almost 50% since hitting a low in May as it ramps up global capacity. Ping An, China's largest insurer by market value, posted an unexpected rise in first-half profit. Net income climbed 3.9% from a year earlier to $8.8 billion, beating estimates of $7.7 billion. Impairment losses fell 17% from a year earlier. Despite pandemic-induced lockdowns, Ping An says its life business did very well. And Vietnam's vast coffee bean stockpiles are shrinking, a phenomenon that's set to push rising prices even higher. According to traders surveyed by Bloomberg, stockpiles will halve by the end of September from levels seen a year earlier. Output from Vietnam, the world's largest supplier of Robusta beans, is expected to drop this year. Robusta is a cheaper variety than Arabica, and it has seen strong demand as people look to mitigate those soaring coffee prices. And that's your Bloomberg Business Flash. So we're all drinking cheaper coffee, Francine.
We are. I mean, one of the funniest things I've read is actually Javier Blas, who said, from September, everyone's going to be back in the office. This is what we're going to do because of energy prices. And now because of coffee prices, we will get employees back full time.
So more incentive to come back to the office is the coffee machine.
There you go. 100% for everyone. I know. Let's also check on the markets, Leanne, to see exactly where we're at. All about Jackson Hole and, of course, that press conference from Jay Powell on Friday. For the moment, we're seeing a bit of a reversal. Nothing huge. The U.S. 10-year yield holding above 3%. Euro dollar 99.50. 42 at below parity, and then European stocks pretty much unchanged, but with a little bit of green. Now, coming up, a whistleblower accuses Twitter of covering up security flaws and fake accounts. Could this help Elon Musk in his legal battle with the social media giant? Well, we'll talk about that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Elon Musk has received a potential boost in his legal battle with Twitter. A whistleblower has accused the social media company of egregious deficiencies in its handling of spam bots and user information. Well, joining us now is Alex Webb from Bloomberg Quick Take. Alex, we had a great roundup yesterday of Jack Dorsey being subpoenaed, and now there's like whistleblower accusations. How does that impact the legal battle?
So it doesn't seem to help his accusation to do with bots, the idea that Twitter has intentionally or knowingly misstated the number of bots on the platform. The way that it might help is that there's a suggestion that maybe Twitter isn't as secure as it purports to be. And if that's the case, then perhaps Elon has the opportunity to pivot and say, well, let's forget about this bots thing. This safety thing is a material adverse effect. That's the key term here. Is there something which gives him an opportunity to back out the deal? So that would be the kind of possible weakness it creates.
So at the same time, Elon Musk also has to hand over information.
Yes, and like that's going to be fascinating as well to see some of that personal correspondence, although sometimes you kind of...
This is SMS? No, or DMs?
We don't know. Presumably, all of that, anything is possible, although sometimes it seems as though Elon just expresses himself on social media, so who knows whether he would have said anything different in private. Personally, I find the discovery amidst all of this fascinating. You know, what's in Jack Dorsey's correspondence, what's in Elon Musk's correspondence, because what sort of the super wealthy say behind the scenes can often shed a huge amount of interesting light.
So will this be public information, or is this just for the courts, I think, in like a smaller state in the US?
Well, it depends what the
information says,
what the Twitter legal team decides to release and what Elon's legal team also decides to release, I think, that and what gets then submitted to the court, you know, for their consumption. So it's not an automatic assumption that everything will become public, but elements of it may well do.
So there's also a Tesla stock split, which used to be, you know, very enticing, but now because of the Twitter conundrum, like it kind of taking a back step, but it's a big deal.
Well, yeah, and there's certainly the hope when you do these sort of stock splits, it's really about addressing retail investors at the moment. And we've seen stock splits from Amazon, did a Google 20-to-1 stock splits. These are sizable ones. Tesla won't be quite on that scale. It's going to be a 3-to-1 stock split. But the idea is that, you know, people who, with the stock at $650, something like that at the moment, go, well, that's a little bit pricey. I could maybe afford $200 and buy one or two shares. And so it creates an opportunity for some investors to get involved who might not otherwise do so. And given the appetite over the past few years, that might have an effect. Equally, are the sort of people who are retail investors going to have that capital given the inflationary context? It may not be quite as easy.
Alex, I read this crazy story, and I've read some pretty crazy stories today on the Bloomberg terminal, but this is amazing. Like there's such Tesla mania, I think, in Korea, that people are actually selling their flats, renting, to make sure that they take advantage of this.
I haven't seen that story.
Okay, it's a great story.
I will check it out. It sounds wonderful. I'll check it out.
And it's basically saying like people are indebting themselves by like $200,000 just to make sure that they get a piece of the action. Alex, as always, thank you so much for making us smarter on that. Alex Webb there from Bloomberg Quick Take. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York. Our Anna Edwards is here in London, and this is Bloomberg.
We're looking at a rocky landing.
You can't kind of overestimate the vulnerability of the economy in corporate America.
There is a broader global story that the market is panicking about what Fed Chair Powell will say at Jackson Hole.
Where I would disagree more with market pricing is the pricing for significant rate cuts.
I think the notion that markets have to move a material amount based on comments on Friday, we think is misplaced.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Investors wait for more clues from the Fed. The Minneapolis Fed chief says it's very clear more tightening is needed. Stocks and U.S. futures stall. 6 months of Putin's war. The invasion has damaged Russia's superpower image. The U.S. will mark the anniversary by giving Ukraine billions more of weapons. And the whistleblower who may rescue Elon Musk. Experts say his revelations could help Musk to walk away from that $44 billion deal to buy Twitter. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, Kriti Gupta and Kailey Leinz alongside in New York. Matt Miller is off today. And Kailey, sentiment pretty weak through the Asia session, pretty flat through the European session so far.
Yeah, we've been struggling for direction a bit when it comes to the Western markets over the last 48 hours or so, Anna, but it seems that the trajectory broadly is lower as we beat the drum to Jackson Hole on Friday. That definitely was the case in the Asian session overnight. Stocks down across the board. The MSCI Asia Pacific Index falling for a fifth day in a row, down by about 0.5%. And China, a real underperformer in Asia, with the CSI 300 off by nearly 2 full percentage points. Of course, in addition to just the broader overhang of the threat of tighter Fed policy and growth concerns, China also has a real problem in the property sector, and that is exemplified overnight by Logan Group. 51% decline for that stock after it resumed trading reported revenue that missed estimates. And of course, this comes as it's weighing restructuring to deal with its massive debt load. So really just underscores the turmoil in the Chinese property sector. And of course, that has been dragging on the Chinese currency as well. The Chinese yuan weaker against the dollar once again today, right around 687.50 at the moment. Kriti, that is the weakest yuan going back 2 years to August of 2020. It is raising the depreciation question. And what exactly policymakers are going to do about it?
And that's a crucial question as we talk about, of course, the ripple effects of the dollar story. Dollar stronger today, as you pointed out, Kailey, against Chinese currencies. But if you take a look at the ripple effects in U.S. assets, well, there perhaps aren't that many. Take a look at the Bloomberg Dollar Index. It's about flat on the session, still hovering around those July highs, though. So that is significant as we talk about simply just how strong the dollar is. Remember, it's the margin of the move that matters, but really no clear conviction, like you said, in today's trading session, even going into Friday, or I should say Thursday and Friday, the Jackson Hole meeting seems to be a wait-and-see approach. The S&P futures up about only 0.1%. 10-year yield not really doing much, only down 1 basis point. Even Bitcoin down only 0.5%. I think what's notable here, though, is that Bitcoin and futures are diverging a little bit, Anna. What does that message, does that really send? We really don't know this early in the trading day.
Yeah, and here in Europe, Kriti, to your point, a picture of a lack of conviction, a picture of a summer lull, perhaps. A lot of grey on this map of Europe right now, suggesting that we are not exactly sure which way we're heading next. But European equity markets then broadly fairly flat. The London market, actually contrary to the futures picture we'd had overnight, underperforms a little bit. And part of that is to do with basic resource stocks. That is an area of weakness here for European equities. We're seeing a little bit of weakness in the London-listed mining sector, but also elsewhere. And you see that sector down by 1.2% right now. Brent crude actually just slowly getting back to levels that we've known recently. 101.58, so having dipped down into the 90s, of course. 101.58 is where we trade, up by 1.4%. This is the Richemont share price, the luxury goods company, up by 2.9%. They're selling their stake in Yoox Net-a-Porter, and as a result, the market seems to like this. Even though they're going to take a charge on this activity, it does seem as if analysts are responding pretty favourably, saying this is something that's been talked about for a long time, and they're pleased to see it happen. There have been some investor pressure piling up ahead of an AGM to come. And SimCorp, this is a company that makes software, Kailey, for the investment management industry. They've had a number of approaches, apparently, to see if they could take that business private. So that stock is down by 4% this morning.
All right, one to watch throughout the trading day for sure, Anna. And let's take a look at what else we are watching throughout the trading day and beyond. The White House is planning to make its long-awaited announcement on student debt relief. We'll have more on that story in just a moment. Plus, we'll get more tech earnings. NVIDIA, the chip maker, as well as Salesforce will both be reporting. And some U.S. economic data is expected, including durable goods orders and pending home sales. Of course, Kriti, we have seen a real softness in the housing data as of late.
It's certainly something we're going to keep an eye on as we start to hear just from a lot of the Fed regional governors. Minneapolis Fed President Neel Kashkari says the U.S. inflation is very high and the central bank must act to bring it back under control. He spoke at a gathering of the Wharton Club of Minnesota yesterday.
With inflation this high, I'm in the mode of we need to err on making sure we're getting inflation down and only relax when we see compelling evidence that inflation is well on its way back down to 2%.
Joining us now as investors wait for more Fed clues is Ksenia Galuchko, Bloomberg Equities editor. A picture of a summer lull, it seems, for European equities at least today, Ksenia. Lacking a little bit of direction, but there are certainly things to look ahead to, Jackson Hole for one, and all the focus is what the Fed is going to say about its path from here, the extent to which it is still laser focused on inflation.
Absolutely, yes. So we've had a tremendous summer rally in both European and U.S. stocks, and that rally was mainly driven by expectations that the Fed will pivot and become more dovish considering the recession risks and some of the poor economic data. Well, now those expectations are being dimmed, and now the market is thinking that actually Powell's speech on Friday will be quite hawkish, and after Kashkari's statements, we are expecting now in the market that the Fed will continue with its hawkish stance.
All right. Well, we will have to continue to watch how these markets behave into Powell's speech on Friday. Bloomberg's Ksenia Galuchko, thank you so much. And of course, beginning tomorrow, Surveillance will be in Wyoming for the Fed's annual symposium in Jackson Hole. Our special coverage will kick off at 6 a.m. New York time, 11 a.m. in London. Tom, John, and Lisa will see you there. Now turning to politics, important Democratic primary results coming out yesterday. In New York, U.S. Representative Jerry Nadler beat fellow incumbent Representative Carolyn Maloney. Meanwhile, in Florida, U.S. Representative Charlie Crist will be the Democratic candidate to challenge incumbent Governor Ron DeSantis in a race that could have implications for the 2024 presidential election. Anne-Marie Horder, and Bloomberg Washington correspondent, joins us now with more from D.C. So, Anne-Marie, which of these results are the most consequential?
Well, Florida and New York, incredibly consequential, also very late in the primary game. I would say for Florida, it's really about the governor race, even though we also know who's going to be challenging the incumbent for Senator Marco Rubio, as well as going to be Val Demings. For the governor race, it's incredibly important, obviously, because all eyes are on whether or not DeSantis will make this 2024 bid. And this is exactly what Representative Crist said yesterday. He's going for his old job. He was governor once before. He was also Republican once before. And he was saying that this is how they could stop Governor DeSantis, the incumbent, to make that race for 2024. The big issue they have is the fundraising dollars. Crist is going to be incredibly behind when it comes to those dollar figures, and really when it comes to the fact that the underdog in this race. And then when you look at New York, this was incredibly difficult for both these individuals, Representative Nadler and Maloney, because they have been in the job for years. They are seasoned lawmakers. They're on very important committees in the House, and they've worked well together in the past. And this got quite heated leading up to it because of redistricting. They were actually facing off against each other. So you have Nadler of the Upper West Side winning over Maloney. This was a big blow to her and her supporters.
And Anne-Marie, of course, we are also due to hear some comments from President Biden as well on a student loan plan. What can you tell us about that?
Yeah, the White House has been keeping this very close to their chest, these cards, and they've been weighing whether or not what to do with this student loan forgiveness. And it does look like they are expected to forgive a debt of $10,000. There would be a cap for those making $125,000 to $150,000. Also, an extension of the pause on repaying debt till December 2022. It's a tricky line for the president and the administration to walk right now, because on one hand, you have many progressive advocates who are saying this does not go far enough. At the same time, what has been the biggest issue facing this administration is inflation, and many are calling the fact that this could potentially be inflationary. But today, we are likely going to hear this. For months, we've been waiting to hear whether or not or how much the president was going to move on student debt forgiveness.
Yeah, cutting it very close to that August 31st deadline. Bloomberg's Anne-Marie Horder, and reporting from Washington, thank you so much, as always. Meanwhile, on the foreign policy front, the U.S. will announce another $3 billion in arms for Ukraine later today. This comes as the country marks a tense Independence Day and 6 months since Russia's invasion. Germany, meanwhile, is also said to be finalizing a shipment of additional weapons and ammunition for Ukraine. Chancellor Olaf Scholz spoke yesterday.
We will continue our international outreach and underline the global dimension of this conflict. We condemn Russia's attempts to forcefully integrate parts of Ukrainian territory. Our message is clear. Any sham referenda or other attempts to alter the status of parts of Ukraine territory will never be recognized, and that such steps preclude any negotiation approaches.
Mark Champion, Bloomberg senior reporter for international affairs, joins us now with more. Mark, we're 6 months in, and we have warnings that Russia's strikes may only intensify. Are there any signs of an end to this war?
Well, in short, no. You had a fast-moving campaign at the beginning. It's become very slow in the east, where the Russians really refocused most of their efforts. They're making virtually no progress now. In the south, they've sent troops to reinforce there and are digging in to make sure that the Ukrainians can't mount a major counteroffensive. So right now, it's a really something close to a stalemate. It's not exactly that because each side is trying to push forward where it can. But we're more or less at a standstill, and there's no sign either of a ceasefire talks or of some sort of breakthrough on the battlefield.
Mark, 6 months into this, a good time to reflect. We came in with high expectations, I suppose, for Russia's military in the sense of what it could achieve against its strategic objectives, and pretty low expectations about Ukraine's ability to defend itself. Both of those seem to be, based on what we've seen in the past 6 months, quite wrong. So what have we learned then about Russia's military might?
Yes, I mean, there were a few people at the beginning who gave Ukraine much chance, and that they were, we in general have been wrong in expectations. That's partly because of what the Ukrainians have done. They've been incredibly innovative and incredibly brave.
And support they've had.
They've had a lot of support, building up over time, but nevertheless. But it's also been about the failures, and maybe even primarily about the failures of the Russian military machine. Partly this was, issues of command and political decision, but, we've also seen some really fundamental failure, an inability, of what military analysts have really focused on, is an inability to do any kind of combined force operations, which is what you really need in order to, create dominance and move forward.
Bloomberg's Mark Champion, we thank you as always. And of course, we'll have more on the war in Ukraine later this hour with Livia Paggi, managing director at J.S. Held, a global consulting firm. That conversation later this hour. Meanwhile, stateside, Elon Musk has received a potential boost in his legal battle with Twitter. A whistleblower has accused the social media company of, quote, egregious deficiencies in its handling of spam bots and user information. Joining us now is Alex Webb of Bloomberg Quick Take. Alex, how do these whistleblower accusations impact Elon Musk's legal battle when it comes to Twitter?
Well, there are two parts to this. Peter Zatko, who's the former executive, he highlighted some things about the approach to spam bots, and that is clearly so far what Elon Musk has been focusing on. It seems the comments he makes don't necessarily support Musk's case when he comes to tackling Twitter. The second part, though, is about the way that Twitter handles user data. And it provides perhaps the opportunity for Elon Musk to pivot and say, well, actually, I'm not going to focus on this bots issue. I'm going to focus on the way that it handles user data, if there are significant failings, and more importantly, if the company has misstated the way that it handles such things, that could create what is known as a material adverse effect. And this is the word at the center of all of this, is the phrase at the center of all of this. Is there something that Twitter has misstated in its public filings, whether intentionally or not, and gives him the opportunity to pull out? So that is the opportunity here to pivot from bots to the security piece.
The saga and its twists and turns. Alex Webb of Bloomberg Quick Take, thank you for your continued reporting on it. Both Twitter and Tesla, I would mention, are positive in pre-market trading today. As for some of the other stocks on the move in pre-market trading here in the U.S., I want to talk about Nordstrom, the retailer that reported results after the bell yesterday. The stock is down more than 13% on the back of that after a cut to the outlook. It is a very similar story than with other retailers in that they have inventory they need to work down. That means discounting and pressure on margins. So if this move holds, it could be the worst day for the stock in about 9 months. It's a much more positive story, though, for Intuit, the financial software company, which makes things like TurboTax, which many people use to do their taxes every year. Its revenue reported and forecast beating expectations. Analysts and investors seeming pretty positive on that, with the stock up nearly 6% before the bell. And finally, I have to do it again. I feel like I've talked about Bed Bath & Beyond every single day for weeks now, but there actually is more news out today that coming from the Wall Street Journal, a report that it has secured a deal with a lender for financing as it tries to boost its liquidity and work down some of its debt. So as a result, that stock is up about 16% before the bell. So there you go, Anna. Maybe I won't have to talk about it tomorrow.
Well, maybe you will. Dangerous for us to say that we won't, I suppose, given recent trends. Kailey, I would suggest. Let's have a look at what's coming up on the programme. We're going to be talking to Christopher Sims, Nobel laureate and Princeton University economics professor. Where are we in the inflation conversation? Has it peaked? How long does it stay at elevated levels? We'll get into all those conversations with Professor Sims shortly. And some 20 million households across the United States have fallen behind on their utility bills. Underpinning those numbers is a blistering surge in electricity prices, which in turn is propelled by soaring costs for natural gas. You can read more about the tsunami of shutoffs that's now anticipated in the United States in the Big Take story on Bloomberg.com, or you can go to NI Big Take. That's the function to use on your Bloomberg terminal. This is Bloomberg.
It's not the actual figure of that would be a bit higher that is the big concern. The big concern is what expectations do workers, do markets, assets have about inflation, because that would determine...
That was Nobel laureate Christopher Pissarides of the London School of Economics speaking to us earlier at the Lindau Nobel laureate meetings in Germany. Joining us now from those same meetings, another Nobel laureate, I'm pleased to say, Christopher Sims. Professor Sims, Princeton University economics professor. He won the Nobel Memorial Prize in Economic Sciences in 2011. Professor, very nice to have you with us. Let's start with the question of the day, question of the year, I suppose, which is around inflation and whether you think it's peaked. I mean, let's talk about the United States. Do you see signs that we've passed peak inflation in the US?
I think inflation will persist for quite a while, maybe into next year. It may have peaked. I don't think it's going to suddenly drop within the next several months. But I think the most likely scenario is that it fairly slowly recedes.
Fairly slowly recedes, but then does it linger at an elevated level? Professor, what does the trajectory for inflation look like to you? Are we talking about something, you talked about months, but are we talking months or are we talking years with inflation above Fed targets?
I think that it's going to be at least months, at least into next year, that it'll be above target levels. Whether it stays above target levels longer than that is hard to predict. It depends on exactly how policy evolves as we go forward. And of course, as we've learned, there can always be a new unanticipated shock that pushes it up or down. Of course, the way the Ukrainian war goes could have a huge impact, and that's very difficult to predict.
Professor, we got some news yesterday that there are 2 regional Fed governors who opted for a 100 basis point hike in the discount rate, not the Fed funds rate. I'm curious, as we go into the Jackson Hole meeting on Thursday and Friday as well, and a lot of the market expecting some sort of extreme hawkish move from Jerome Powell himself. I'm curious your take about what that discount rate kind of divergence really means for the broader Fed funds rate path.
I think the details of the timing don't matter that much, so long as everybody understands that the Fed is focused on getting real interest rates, that is the nominal interest rate they set minus the current inflation rate. They're intent on getting that into positive territory. That is, so even if they don't do it at their next meeting, they will keep on raising rates until they get positive real rates. So long as everybody understands that, the exact timing of that sequence is not likely to be terribly important.
What does that mean for the liquidity picture then? We, of course, are seeing a historic move when it comes to quantitative tightening. Meanwhile, the market's really struggling with that thin liquidity. Is it something you're worried about?
Well, it's something that's a normal pattern as monetary policy tightens. Liquidity, rates on interbank loans, these things begin to show signs of stress when monetary policy tightens. It's part of how monetary policy works. So it is concerning, but it's not unexpected.
Professor Sims, as we talk about tightening policy, there is a question of what the result of that will be, not just if it means inflation is down, but growth as well. Where do you put the odds of a global recession?
That's a hard question. I don't think it's certain by any means. Some people would say that with the yield curve inverting, that a recession is almost inevitable. I don't think it is inevitable, but it certainly could happen. It could also happen if fiscal policy worldwide is on average much too expansionary. We could have no recession because we fail to succeed in bringing inflation down. I don't think that's very likely, but it's something people should keep in mind as another possibility.
Well, and of course, the trajectory of global growth is not just dependent in large part on the U.S. economy, the world's largest, but also the second largest, China, which has a multitude of problems of its own. And there's tensions between those two economies, this idea of perhaps further decoupling. I'm wondering what you see as the future of globalization, if we will indeed be a more deglobalized world, and ultimately what the economic implications of that are.
Well, we have already become less globalized in that the U.S. has moved into a regime where tariffs are being used as a policy instrument, and tariffs are, even though this was started with Trump, Biden has done little to move back from it. And once tariffs go up, it tends to be politically difficult to get them back down again. So I think we're in a less globalized world already. Whether it becomes much more deglobalized, I think it's hard to say at this point. You're right, the problems China has with its economy could lead to further deterioration in the links between our economy and theirs. And this is an important issue, but its outcome is very uncertain at this point.
As is so much. Thank you so much for your time today. Christopher Sims of Princeton, a Nobel laureate in economics. We sincerely appreciate your insight. Now, coming up, as we talk about the global economy and central banks, what are the implications for foreign exchange as we have a persistently stronger dollar and a weaker pretty much everything else? We'll discuss with Esther Reichelt, Commerzbank FX Strategist, coming up. From New York and London, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Investors wait for more clues from the Fed. The Minneapolis Fed chief says it's very clear more tightening is needed. Stocks and U.S. futures stall. 6 months of Putin's war, the invasion has damaged Russia's superpower image. The U.S. will mark the anniversary by giving Ukraine billions more in weapons. And the whistleblower who may rescue Elon Musk. Experts say his revelations could help Musk to walk away from that $44 billion deal to buy Twitter. I'm Anna Edwards in London with Chrissy Gupta and Kailey Leinz over in New York. Matt Miller is off today. And Chrissy, yes again, another day where we're kind of stalling, scratching around, waiting for the symposium at the end of the week. All eyes on Wyoming.
Yeah, it's kind of that wait and see mode that continues to really dominate the trading. Although I will say, even in the last 30 minutes, you have a little bit of a negative kind of tilt showing up in U.S. futures, and that's going to be significant. 30 minutes ago, we had futures actually tilt higher about 0.1%. Now they're about unchanged, but tilting into negative territory. And in the meantime, we've actually seen Bitcoin drop further and further into negative territory. Once again, only down 0.6% relative to the 0.4% in negative territory it was about 30 minutes ago. So once again, these are very marginal moves. Nevertheless, you are seeing risk sentiment perhaps turn for the worse just a touch. Nevertheless, in the 10-year yield and the dollar, once again, the story really is unchanged. Kailey, rescue me from the boredom on the macro front. Walk us through the micro.
Well, it may be unchanged across some asset classes, but actually you've seen some real strength coming through for oil in recent days, Kriti, which is why energy was far and away the outperformer on a sector basis yesterday, even as the broader market was struggling for a direction. And once again, you do see those energy stocks getting a lift in early hours with WTI around $95 a barrel once again. The likes of Occidental Petroleum up about 2.2% and Marathon Oil up about 1.5% as well. And I have to talk about the meme stocks, as I do pretty much every day now. Bed Bath & Beyond, of course, has seen a lot of action, a lot of volume and volatility. Lately, it has been more so to the downside, but this morning up nearly 16% in early hours after the Wall Street Journal reported it has secured a financing deal with a lender as it tries to boost its liquidity and work down some of that debt. And you're seeing a little bit of a bid coming in for other meme stocks as well, the likes of GameStop, Anna, higher by about 2% in early hours.
Yeah, I was reading how this could be, once again, another talking point as we head into the fall, into the autumn. Apparently, it chimes well with student calendars. Let's have a look at where we are on Europe. This is the European stock market right now. Stocks Europe 600 down by 0.2%. Again, that wait-and-see pattern. Basic resource stocks, one of the areas of weakness, and that means that London is underperforming, so we're down by 1.4% on that sector. Brent crude, just keeping an eye on where we are on the oil price. After recent highs, we sank back a little bit on expectations, perhaps, of slower growth globally and maybe of more production. Well, the Saudi news of just a day or so ago certainly asking questions about where production goes from here from OPEC+. And Brent crude back above $100. 101.30 is where we trade right now. And this is the Richemont share price up by just shy of 3% as the luxury goods company is selling its stake in Yoox Net-a-Porter. It was trying to put together an online platform for selling all kinds of brands across the luxury space. Well, that hasn't exactly panned out as expected. And even though they'll take a charge, Kriti, on this particular action, it does seem as if analysts welcome the move.
Well, let's certainly go from the micro, once again, right back to the macro, because we have to talk about this foreign exchange story, which is really permeating a lot of the bottom lines for a lot of not just corporate America, but I would say corporations around the world. Joining us now is Esther Reichelt, Commerzbank's FX Strategist. Esther, thank you as always for joining us. Let's dive right into the euro story here. It is below parity, but I'm curious how much of that pain or that weakness that you're seeing in the euro is not necessarily a story of the energy crisis in Europe, but perhaps a story of the ECB's ambivalence. Your thoughts?
Well, that's an interesting question because what we have seen is that there is an increased correlation between gas prices and the euro. So if gas prices go up, euro goes down. What we've also seen since the beginning of August is that the market has corrected or has priced in more ECB rate hikes, but the euro was not able to benefit from that. And I think clearly that's because the ECB in general is seen as a very reluctant central bank, while the Fed is giving, or while we hear more and more hawkish comments from the Fed, even from traditionally rather dovish central bankers. So as long as this divergence exists, I think it will be hard for euro-dollar to go back up again.
So what will it take? I mean, what kind of forecast are we looking at here? I believe the consensus here is that the euro is only going to go weaker as we head into the winter. But I'm curious what the pivot point is to get it perhaps back above parity and sustainably so.
Well, on the one hand, maybe a surprise on the geopolitical side, or maybe, like some indications that the gas crisis is going to be less severe than feared. However, this is really, like a gamble and can't really set on that. I think any up move in euro-dollar is rather going to come from the US dollar side because the market currently prices in that the Fed is going to reduce rates next year. It's already repricing this a little bit as the Fed remains hawkish. However, if the Fed is actually moving more towards the market side, I think we will not see much, or we will not see euro-dollar levels much more below, or much stronger below parity.
Okay, Esther, just sticking with the euro for a moment, I was quite taken by some comments earlier this week from the Belgian Prime Minister, who suggested that Europe could be facing 5 to 10 tough winters. I wonder whether markets are, I mean, we don't know if that's true or not, but I wonder if markets have a sense, an accurate sense of the time horizon for this particular energy crisis.
Well, I would say absolutely not. Everybody's focusing on the winter that's right ahead of us and not thinking much longer. And I'm not sure whether this would already be a story for the exchange rate, or because it's too far, you know, like the uncertainty is too high, and we have so high risk premiums already for the short term priced into the exchange rate. I think we will only face this as we come out of the winter of this winter, and we will see how inflation behaves, how what potential to move the ECB has, and you know, like the next winters will only be a topic maybe for exchange rates coming in spring.
Let me ask you about the other side of that euro-dollar pair then, and that is the dollar, or rather stepping away from the euro side, Esther. On the strong dollar, it seems to be such a consensus play. I wonder what is the best way to play the dollar here, because the euro obviously has travelled a long way, maybe other pairs less so.
Yeah, that's a question on how interested in risk you are, you know, because as I said, there is a divergence between the Fed and the market. You know, like the Fed is indicating that they are going to hike stronger, or that they are going to expect more rate hikes, and that they are going to stick to a high interest rate level. That's not what the market is pricing right now. You know, like the market still expects the Fed to cut rates if we indeed see a strong recession. But there is huge uncertainty, and which can benefit investors which play it right, because we are seeing sentiment deteriorating. But in the real economy, the recession fears are not yet there. So there is a lot of uncertainty that could benefit the risk-interested investor.
Well, Esther, we talk about the Fed tightening policy, and there's other central banks that are doing no such thing, namely the Bank of Japan. I love in your note, you have a line in there that says the yen stands no chance against the U.S. dollar. What are we realistically looking at dollar yen, and will that ultimately change the calculus for the BOJ?
It might, because let's be honest, the Bank of Japan is going to be like, it doesn't have any more it can do to ease monetary policy. It doesn't want to tighten monetary policy, as inflation is still quite low, in particular in global comparison. So dollar yen will be just the dollar side. And if we expect a further dollar strengthening, dollar yen can easily move towards like the 140 mark or something like that. However, the Japanese side, or the yen side, is totally passive with respect to the dollar yen outlook. They just have to take what comes from the global side.
Esther, thank you very much. Thanks for joining us. Esther Reichelt, Commerzbank's FX Strategist. Thanks for spending time with us here on Bloomberg TV. Coming up, on the war in Ukraine, we will be speaking to Livia Paggi, Managing Director at J.S. global consulting firm. We'll get her perspective on where we have travelled to in the last 6 months, and where will the conflict go from here. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today on The Open, an interview with Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. That's at 9:30 a.m. New York time. This is Bloomberg.
It has never been more important for us all to stand together in defense of the foundational principle of international law, which is that no territory, no country can acquire territory or change borders by force of arms.
Boris Johnson, the UK caretaker Prime Minister, speaking yesterday at a virtual summit where world leaders strongly condemned Russia's invasion of Ukraine. It's the 6-month anniversary of the war, which has upended fundamental assumptions about Russia's military and economy. Livia Paggi joins us, Managing Director of J.S., a global consulting firm. Livia, good to speak to you. Have you been surprised, I suppose, at the ability of Ukraine to withstand the invasion and the fact that we still witness war on the European continent after 6 months?
I would not say surprised. The Russian strategy has always been in war to win by protracted conflict. We've seen them in Afghanistan, we've seen them in Georgia, and in a few other post-Soviet countries, and that has always been the strategy, which is effectively to create frozen conflicts where they dominate certain areas and it becomes a war of attrition. However, at this point, we do not really see any real hopes for a resolution to come. At the moment, all diplomatic channels seem to be shut down between the West and Russia, and Ukraine and Russia.
And do you have an idea of what it is that Russia is trying to achieve now? We had a sense of their goals, their aims at the start of this conflict. What do we think they're trying to achieve now?
Russia's goals are very consistent, which is to weaken Ukraine, to effectively dominate Ukraine, to restore a sense of greater Russia, Eurasianism over the entire post-Soviet space, which includes over Ukraine, and effectively to make it entirely dependent on Russia so that it cannot function as an independent state or a state that can forge close ties with the West.
On the subject of the West, Livia, obviously in the last 24 hours, we've learned of more pledges from Germany as well as the U.S. for more military aid. But we're 6 months into this conflict, and what you're describing is a conflict that is going to last for some time in the future. I'm wondering to what degree you expect there to be Western fatigue and waning support for Ukraine the longer this drags out.
This is a really key question. We have seen Western leaders up until now really rally around Zelensky and support him. We've also, as you've mentioned, we've seen these huge packages be delivered to Ukraine. However, there is a very high price that Europe is paying, and there's a number of global implications as well for food shortages. But taking Europe alone, we're seeing 96% inflation in gas prices for the UK. The former CEO of national oil giant in Italy mentioned yesterday that Italian industry can't compete anymore. So really, I think it's going to depend on how this winter goes. The states in Europe are going to have to heavily intervene in order to protect businesses and consumers to the extent, and household consumers to the extent possible. And after this winter, we will have to regroup and see where we are and how much European governments can tolerate this current economic crisis that we're effectively entering into.
Well, sticking with the subject of energy and the weaponization of it, Livia, obviously already there has been reduced flow of Russian natural gas into Europe. There remains a question of whether the taps are going to turn off entirely. If Vladimir Putin has to continue to fund a war of attrition, does that political and economic calculation make sense to you? I mean, how large of a threat do you realistically think there is of a cutoff in its entirety?
So what we've seen is that Putin he's been turning on and off the tap, right? So he's effectively controlling the gas market, and that's what that's the main political point he's trying to make, is that he has full control over these gas prices, and when it's convenient, he can open the taps, and when it's politically or economically not convenient, he'll close the taps. He does have other markets, gas markets, so China and others are at the moment acquiring gas, and he does have a significant oil market which he can sell to. However, I think what we need to keep in mind about the Russian state is that they are incredibly resilient. If the Russian state has to wait it out and there's an economic hit for several months and that politically suits them, they will take the necessary steps to do that. So not all of Putin's calculations are necessarily economic, purely economic.
Livia, I'm curious from a Western perspective. You look at the likes of the U.S. and Europe, they've really thrown the kitchen sink at holding Russia accountable. Have they also hit the upper bound on what they can do in that regard?
I mean, I would certainly say that from a sanctions perspective, there is very little additional steps that they can take. Most of Putin's close allies have been sanctioned. Major state entities, state companies have been sanctioned. So from a pure regulatory perspective, there's not very much additional steps that the West can take. I think at this point, what the West's main weapon in this conflict is to keep on funding Ukraine, because obviously Ukraine independently is not able to win this war against Russia. So the way that the West can continue on to look to undermine Russia is by continuing to fund arms to Ukraine, give them aid packages, and move in that direction. As we've seen, it's impossible for the West to entirely cut off energy supplies because the hit is too big to our economy. So it's unlikely that the West can fully, undertake an embargo against Russian gas this winter. That is not an option we have, and it's not really an option to put an embargo on Russian oil either.
Livia, drawing on your experience with emerging markets that have been in crisis, I'm curious what kind of timeline you're advising your clients on. How long could this conflict continue to last?
At this point, we're certainly looking at the next 6 months, because at least 6 to 9 months, because the President Putin is certainly going to be looking to capitalize on the winter and make sure that he can do as much damage as possible to the West with the winter. So we'll see. I think we'll be in a better place to assess the situation where we are in February, March of next year of 2023. We will get a sense of what the economic hit was on European industry and households, how much the governments have been able to fare, and also where the Russian state is in terms of resources to fight the conflict, in terms of weapons and cash.
Livia, thanks very much. Thanks for joining us. Livia Paggi, Managing Director of J.S. held, joining us to talk about 6 months of war in Ukraine. And tomorrow, with a focus on the macro, back to the macro themes, and Jackson Hole. Surveillance heads to Wyoming for the Fed's annual Economic Policy Symposium in Jackson Hole. Our special coverage kicks off at 6 a.m. New York time, 11 a.m. in London. This is Bloomberg.
I think it could be a couple of years. I mean, if you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target, and ultimately they do want to get back down to pretty close to 2%.
Well, that was Jan Hatzius speaking about his take on the economic forefront. Of course, the Goldman Sachs chief economic speaking yesterday on Bloomberg Surveillance. Tom Keene, now co-anchor of Bloomberg Surveillance, joins us after his conversation with Jan. Before he hops on by plane, train to automobile to Jackson Hole later today, he's joining us with a single best chart. Tom, what do you got?
Oh, we got the history here. As Dr. Hatzius was talking about, it spans years of Fed policy. Let's go right to the chart. On radio, I need to explain this. This is from Volcker to Powell across 40 years. The great disinflation is described by the regression. Everything changed in August of 2007. Boy, was that a Jackson Hole. And then something changed. And what changed is the theory underlying all. And this is from John Taylor of Stanford University. We do the chart in Stanford red. And all you need to see, it's real simple. The white line used to be above the red line, and it's not anymore. And Critty, this is the massive divide between underlying monetary theory from the giant John Taylor of Stanford versus where we are right now. This is the conundrum that all will greet in Jackson Hole.
Surely something you're going to be presenting to your guests on the show. Who do you have?
Well, we're going to line it up here. John, I think John is maybe, I think John's here. I hope he's here to do the show with us. But we've got a great set of guests, including Lori Heinel of State Street Global, Tom Porcelli, written up by Andrews Evans Pritchard in the Telegraph today in London. Tom Porcelli will join us on the key thing here, which is the labor economy and how that folds into all. And then Jim Caron will start us off strong. As you know, the market's somewhat quiet today, but the fact is the bond market speaks all. So Jim Caron will join as well.
All right, looking forward to those conversations, Tom, and hoping you bring a bolo tie and cowboy hat to Jackson Hole as well. Tom Keene, thank you so much. Now let's take a quick look at what else we're watching today. I will be watching the tech earnings story, specifically NVIDIA reporting after the bell. Remember, it released prelim results earlier this month that were pretty disappointing. It said fiscal second quarter revenue was going to come in about $1 billion lower than predicted, thanks to shrinking PC sales and sluggish demand for computer games. So the focus isn't just going to be on the numbers from the quarter they report, but really the forecast and what signal it sends about whether that decline in PC chips is something temporary or longer term. The stock is down more than 40% year to date heading into those results, Creedy. So it'll be interesting to see what kind of upside or downside catalyst those numbers are.
And sticking with that, of course, it's a multinational company at the end of the day. It's going to have a massive effect when it comes to the dollar, which brings me to the macro front. That's what I'm watching, Anna, specifically the dollar and what ripple effects you're going to see in the stock market and the commodity market as well. Is it actually following what the bond market is telling us, or is it kind of marching to its own drumbeat?
Yeah, absolutely. We'll keep watching the dollar then. Interesting conversation earlier with Esther Reichelt about the ways to play that strong dollar theme, if you believe that's still intact. I'm focused on the big take. I want to give a plug to the big take story today, which I found quite eye-opening. 1 in 6 households in the United States are already late with their energy bills, and this is before the sort of global realities, I suppose, of higher gas prices filter into fully the United States, because natural gas has pushed higher. That has a knock-on impact onto electricity prices in the US. This problem, of course, something that's quite acute, very acute in Europe. We've talked a lot about it. Governments dealing with it differently, and we continue to ask questions about how long prices are going to stay at these elevated levels. A lot of different assumptions being made there. That is it for the early edition. More surveillance is ahead. This is Bloomberg.